You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin, his website, oilandgas-investments.com. Welcome to the show, Keith.
Jim, good to chat with you again.
The price of gasoline, we notice, still hasn't gone down all that much, even though we're out of the so-called driving season. Is there any reason for that?
Yeah, there's a couple big reasons for that, actually, Jim. Whenever people get really uptight about gasoline prices, people totally forget our Canadian dollar has just been slaughtered this year. Like, in February of 2015, it lost 10% just that month. So we've gone from like a 92-cent dollar at the beginning of the year to about a 75-cent dollar right now. I think we might have got a little bit closer to 80 in the last little bit. But, you know, that just really hurts consumers. Like, that makes gasoline, which is priced in U.S. dollars, so much more expensive. So, like, gasoline at its peak here in Vancouver was probably $1.52 a liter, maybe, give or take a penny. And then now it's sitting here, and that was when oil was $110. And, of course, now oil is $44. And gas has only dropped a little bit, though I see that we're down to about $1.14 a liter. And the main reason for that, Jim, is our Canadian dollar. If we had the same 92-cent dollar that we had in January, gas would only be $1 a liter here in Vancouver. Like, that's a big difference. That is a big difference. So that's the number one reason. Like at 15 cents a liter, that people notice that. That's a big number. And then, of course, the other big difference, Jim, is that demand has just picked up so much across the world, but especially in the States with lower prices. Their gasoline prices have dropped much more than ours have because they've got a freer, more fair market. And so when you have increased demand, you're going to have increased prices. It's that simple. Do
you see gasoline prices in Canada coming down significantly in the near future?
Well, significantly is a tough word, but I would say that they're definitely going to come down because what's happening here is, you know, everybody knows we've got lots of oil in the world right now. And we've got huge inventories in the States, like all-time record high inventories, well over 400 million. At one point we got pretty close to 500 million barrels of inventory. Well, that's a long time. And it's funny, a big chunk of that is actually Canadian oil that's been imported into U.S. storage because our oil sands production is so high. But all this oil glut it is slowly turning into a gasoline glut, Jim. So every week when the EIA numbers come out with their statistics on Wednesday morning, you see an increase in gasoline almost every week now. So at some point in time, that is going to translate into lower prices. Continued lower prices. I don't think they're going to collapse from here by any stretch, but I think there's 10% downside, and at some point over the next 8 weeks before heating season starts, middle of November, we could see another 10 cent a liter drop here in Canada for a short time.
And if they have a huge surplus of gasoline in the U.S., would they ship some back to Canada just to get rid of it?
Oh yeah, yep, absolutely. You know, we get a lot of our gasoline from Alberta, but the U.S. has made it a mission to increase exports of their refined products like gasoline abroad, and they're up to over 4 million barrels a day shipping around the world, and I don't know exactly what the Canadian number is, but I'm sure we're fairly high up.
The XL pipeline, I heard now Hillary is against it. Is this a political football that won't go away?
Well, I don't know. I kind of think it already has gone away in the sense that it's pretty clear it's not going to happen. All the Democrats have basically come out and said we're not going to approve it. So that's going to be a really negative thing for Canada because it's going to mean lower oil prices for us for a couple of reasons. You know, until oil gets so cheap that rail comes back and is economic, and I would think oil would have to drop another, Canadian oil discounts would have to increase, meaning our price would decrease, another probably $7 a barrel to make it economically worthwhile to train our oil down to the Gulf Coast, which is what happened when we saw some big discounts here in 2013 and 2014. But now the price difference just isn't big enough to warrant that. But we have so much oil coming out of the oil sands, Jim. It's just crazy. Like this year and next year are two of the biggest increases we have over the next 5 years. And these assets are like multi-billion-dollar oil sands assets where the decision was made to increase production back like 3 years ago when oil was $110. You just can't shut that off. And so now you're in a position where all of a sudden we've spent tens of billions of dollars on the oil sands, building them out, and the market's gone, and you just can't turn that off. Like, people would basically have to be convinced, Jim, that oil is going to stay at $30 or less for like 5 years before they're going to shut that oil sands production in. And what that's going to mean is some pretty low Canadian oil prices.
So Canadians, even if we buy oil from the oil sands, we're paying in U.S. dollars instead of Canadian dollars.
Right, because because we export so much to the U.S. That's right. We basically export all the oil we don't use domestically to the U.S., which is a lot.
We'll have more with Keith Schaefer right after this.
Unbelievable harmonies, spectacular performance, Bird Dog and the Vintage Electric Band, the ultimate tribute to the Everly Brothers and Simon and Garfunkel in Oliver, October 2nd, in Kelowna, October 3rd. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Keith Schaefer. Keith, I've heard fracking has not worked out as well as many people predicted in locations outside of North America.
Yep, that's a fair comment. I think there's a couple of big reasons for that. You know, one is that, frack jobs now, Jim, are small cities. You look at a picture of what a frack job looked like in 2004, and there might be 2 or 3 trucks there. There'd be no sheds or anything. Everybody went home at night. Now, these things run 8 to 10 acres sometimes. You're drilling 8 wells off one pad. You've got, I don't know how many trucks with sand on site and pressure pumpers all lined up in a row. Like these well sites now sometimes have their own small little store. They have overnight accommodation for the workers. They're drilling 24/7 now. A lot of the time, they've been doing that in the States for a number of years, and it's just happened the last couple of years in Canada. So they're, from a services point of view, from a support point of view, it's an incredible logistical undertaking to get one of these big well pads drilled and fracked. And the free market economy of North America has allowed the services industry to basically move around unfettered, and they can get any part you need the next day. So that's great. You just go out to the site, you start building it, and whatever you need, maximum next day delivery. You go to a place like Argentina or someplace else like that where the services sector is very small. They have to import almost all the parts. Almost none of the parts are made there. And you're talking about things sitting in customs warehouses for days, if not weeks. So it's, because of that, the shale revolution just has not lived up to any expectations in foreign countries. And I guess the other big thing about that, Jim, is that, you have to be a big company to work in these foreign places. Like Australia's got lots of interesting shale, but it's in the middle of godforsaken nowhere, in the middle of the country. So weather says you can only drill there in the dry season, so 6 months a year. There's no infrastructure in the middle of Australia, so you got to be a huge company to do that. The juniors can't do it. Same thing in Argentina, but it's more because of the politics. Everything takes forever down there, so you don't have near the same kind of capitalist culture that you do up here, so everything takes more time, more money. You're a big company to survive that.
So at least in one area, North America has a big advantage over the rest of the world.
Oh, absolutely. And a great test of this is going to be Mexico, because on December 15th this coming year, 3 months from now, they're going to have their second round of bids opening up many of their properties to foreign capital. And a good part of this second round is going to be some of the onshore shale stuff that's just south of Texas. So it'll be really interesting to see once that gets done exactly how the services industry responds both in Mexico and up here, and if there's going to be much transport of equipment and personnel down there to allow things to move quite a bit quicker.
Do they have the personnel to man these sites, or are they going to have to rely on Canadians and Americans to do it?
You know what? I don't know the answer to that question, Jim. I would say that the Mexicans, through Pemex, have a long history of very able workmanship down there. You know, the problems with Pemex have been political, so it'll really be interesting to see how many expats they need in the technical positions. I think that it won't take long to train the locals down there for whatever they need, just because there is such a long history of an educated workforce in the energy sector there.
Keith, anything else you think we should be talking about right now?
Well, it's just interesting, Jim, to hear on natural gas the very different opinions that are out there right now. You know, the big brokerage firm in the U.S., Credit Suisse, came out with a report here a week ago saying as early as November they see natural gas prices rising dramatically all through the winter based on a huge supply shortfall. And really what they're saying is that the Marcellus in Pennsylvania, that big formation, is being tapped out. But almost everybody else I talk to, Jim, says that no, you know, once the costs have come down so much and these wells have improved their efficiency so much that basically at $3.25 gas, a lot of these companies make awesome money, and we're never going to see any prices above that because they'll just hedge it out. So it'll be really interesting to see come Christmas this year where we're at in natural gas, because there's been an increasingly loud voice of the bulls, but boy, oh boy, you know, costs have come down, and these wells in the Marcellus and the new Utica formation, which is just below the Marcellus in Pennsylvania and Ohio, those wells are coming on with some incredible flow rates, Jim. Like a good well in Canada might be initial IP rate, like a really good well, a stunningly good well, might be 15 to 20 million a day cubic feet of gas. But most of them are like between 6 and 10 million cubic feet a day. You're seeing wells in this new Utica formation in Ohio, Jim, 60 million cubic feet a day, 59.8. Like, that's just unbelievable. The resource that they're developing there is just stunning. So it'll be interesting to see how this plays out here in the next 4 months. Keith,
thanks a lot for chatting with us.
Jim, God bless you. Chat in a couple weeks.
My guest has been Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin. His website, oilandgas-investments.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. Comments for the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.